Welcome to the Daily Update. This is being prepared Tuesday, May 17th, where we'll look at the action in the market today and then see how things look for Wednesday, May 18th. It was a pretty strong day. We needed some follow through because we saw some improvements start to happen, and we got that follow through. Now, the next question is, can the follow through continue? To recap what happened on Tuesday, right at the open, we had a gap higher. The futures were strong pretty much through the night and just stayed strong even after the retail sales report came out, and we had a gap higher. We actually went above R1, which was at about 40.42, but we didn't quite get up to R2. The pivot levels for Tuesday were not really far apart because Monday's session was not really wide. Tuesday's pivots are based on Monday's price action. After the open, prices fell back to the R1 level. And then as the day went on, prices rose back above R2 at about 40.75. We actually got above that level. Going into the close, there was a little dip there for maybe 30 to 45 minutes or so, but prices were able to climb, and we closed really close at the high. We were up 2.02%. Volume did advance from Monday's pace, but we're still below average overall. And the technicals, they're still negative, but showing some improvement. We needed to see this if some positive things are going to develop. Now, anything can happen from here forward, but when we take all the information together, it's starting to look more positive. Of course, the real fixation right now are inflation and interest rates, different geopolitical concerns that are going on, as well as earnings reports that are being released. So what are some comments that we can make? We did get back above the 40.61 level, which is that longer term support line that I have on one of the charts that I'll show you. Interest rates and stocks rose together. So you had interest rates going up and stocks. So this idea that if interest rates are up and stocks go down and vice versa, that hasn't really been into play now for the last week to week and a half. The China lockdowns may be easing. There's some reports coming out of China that they haven't found any more COVID cases in the last 3 days, so they may be lessening the lockdowns there, and that could help get their economy going again. And we buy so much from China that might help some of the supply chain issues. The technicals continue to show improvement, and I'll go through and show you lots of charts that back that up. Fed Chair Powell did have a speech on Tuesday, but he pretty much just said what he's already said before. So the markets didn't really take anything new away from that. Fear still remains extreme, and this could be positive because you have so many bearish folks out there. The market's not going to go up. The market's not going to go up. Well, we're still camped out at an extreme level. The technical picture is improving. We would not necessarily be surprised if we see the markets climb from here. But we're still in correction territory overall. The economic reports that came out, retail sales, they did increase 0.9%. They expected 1.1%, so it was a little less than expected. Industrial production increased 1.1%. That was a lot higher than what was expected at 0.5%. Capacity utilization increased to 79. They expected 78.6, a little higher than expected. And the Housing Market Index decreased to 69. They were expecting it to decrease to 75, and it had been 77 last month. So we're seeing a little bit of continued weakness in the housing sector. And the other report that was released were business inventories. They increased 2%, and the expectation was for 1.9%. A little bit stronger than expected. Our trend is negative, and it's weakening a little bit. With these up days, we're starting to see the red line come down. We're starting to see the green line go up, but it's still above 20, and it's still a negative trend. The bias, I've switched more to mixed right now. You could maybe say positive. Monday, even though it was a down day, was not really negative. And Tuesday, of course, was a pretty strong up day. But there's still a real negative backdrop that we have to overcome here, and a lot of levels that prices need to get to before we really see this in a more positive light. The momentum, I've switched from mixed to negative. We've been negative a lot more than positive lately, but we might be seeing something improving. If we have another good, solid up day with our charts improving, I might switch the momentum over to either mixed to positive or just straight positive. One chart that came out that kind of fueled things, the cash levels as reported by Bank of America, they're at the highest level since 9/11. What does that mean for the stock market? Well, what do you use to buy stocks? Cash. And if there's a lot of cash sitting in accounts, if the market looks to be getting more positive, some of that cash may come in and buy stocks and push prices even higher. So that was used as kind of a positive signal. Let's go back and look at the day's session. We are still extreme negative. We ticked up from 15 to 16, but we're still showing some extreme fear. And over here is the area that we're kind of camped out at right now, which again is kind of strange because usually we see more of a V-shaped bounce. You could say we V-shaped here. We're not seeing a lot of price action that's drawing off the fear. Fear has been extreme now for a number of days. The VIX continues to decline based on a closing basis. We're getting down to the moving average. On the bar chart, we actually gapped lower. We're below the moving average, even though we closed right on the moving average on the bar chart. The VIX of the VIX is also really slowing down. It really dropped on the bars, and we had a real decline on the closing basis. So that's just showing that the hedging is lessening. People aren't as fearful that deal with the VIX. Now, the rest of the world is still freaked out on a sentiment level, but those people that participate and do a lot of hedging, they're not as fearful right now. They don't want to necessarily be hedged if we're going up because that bites into their overall returns. They want to hedge when things are going down to protect what they have on the line or to protect profits that they've already enjoyed. The Ulcer Index does continue to go up slightly. So that shows, according to this indicator, that fear is still increasing. And here's a longer term look of that chart as well, just showing how we've spiked out at these levels in the recent past. Doesn't mean we will spike out here. It just means that at other times, when we got to this level, that was an extreme reading. But back here in 2020, 2021, those were different economic environments than what we're in right now. Equity put call ratio actually went up a little bit. Imagine that. We have a 2% up day and more people are buying puts than buying calls. So we're seeing kind of some mixture here. We're seeing the VIX really decline, but we're seeing hedging, at least on equities or stocks, that is increasing. Even though it's not at an extreme point, just to see it go up on an up day is kind of strange. The 5-day moving average ticked up just slightly, and we're still at a pretty extreme level. Looking at the sectors, 10 out of the 11 ended up being positive, with tech leading the way, up 2.9%, materials, financials, discretionary up over 2.5%. And the one sector that was down were staples, which have been holding up fairly well. So we saw a lot of growth. On Friday, growth won. On Monday, value won. On Tuesday, growth kind of came back in and took over again. Going back to the all-time high, we have energy in the lead, followed by utilities. Staples are actually now a little bit negative since that all-time high. Way over on the right, discretionary, even though they had a good day, are still down overall, as well as communication, tech, financials, and real estate. And even industrials are down over 10%. Technical alerts, all of them were positive. On the NYSE, we had a BPI that crossed above 30. That is now an oversold bounce. So that is positive. The healthcare sector had a bullish MACD crossover. Tech also had a BPI that crossed above 20. The NASDAQ was able to get above 11.8, then 11.7, then 11.9. It's bouncing around a little bit. Cyclicals are showing some improvement. Tech showing some improvement. Communication. These are the areas that were really getting beat up, and now they're starting to bounce. Can it continue? Intraday. Way over on the right-hand side, we did gap up above R1. We didn't get to R2. We danced kind of sideways for quite a while. Fell back down to just a little bit below R1. We're able to bounce back above that and climb a little higher. R2 did become resistance, and we kind of camped out right along this line. Here's the little bit of a sell-off that we saw as we got later in the day, but that quickly led to some more advances, and we were able to maintain the gains and close pretty much at the high. So it was a pretty positive day, but there's a lot more that needs to be done from here for things to really improve. Here's the long-term support level. We were able to get back above that, and I have a blue little circle there to highlight where we're at. And down at the bottom, we see where volume was greater than on Monday, but still below average overall. That's a little bit of a warning sign. Got a lot of people that don't really trust what's going on, which could work to its favor. This is what we saw in the middle of March. People didn't trust it until it got to the top, and that's when they started really getting in. Well, we were at the top at that point, so they're getting in at just the wrong time. Then, just to show the longer-term chart here, we got back above the long-term support, and this is a real mess right in here. I know it's kind of hard to look at. We really only look at this when the market's going down, but we just have a lot of overhead resistance that we could run into. We're down 14.75% from the all-time high. As far as the technical overviews, nothing has really changed here. Yeah, things are improving, but nothing has really flip-flopped yet. Energy, commodities, gold, interest rates, and staples, they still remain stronger than the relative market. Where the things that are negative, it's the same list that I've been showing now for quite some time, so there's really not an awful lot of change. Even though we're seeing a bounce, a lot of damage was still done. And it's going to take some pretty significant moves to have this list start to change. As far as our trend, we did see a decline on selling. We saw an advance on buying, so the ADX came over and it's right on top of the moving average right now, but it is turning down slightly. However, it's still above 20. The red line is on top, so we defer to a negative trend. The Arun also saw a decrease in selling, an increase in buying. The oscillator has turned up and is going higher, but it's still negative because it's below zero. Breadth saw another pretty strong day. The advanced decline line based on price really bounced up. We're right at the moving average. Based on volume, we also turned up, but we have a long ways to go before we get back to that moving average. The new highs and new lows, we're back more into the neutral category. We're now registering an 11. So we're slightly positive looking at that. The 10-day average, after being fairly extreme negative, is continuing to show some improvement. We're now at 32. Advanced decline ratio. The blue line is trying to go above zero right now. So we're seeing an improvement in the advanced decline line ratio. New highs and new lows. This is what we started to see last week. We're seeing not gangbuster new highs, but we are seeing more new highs than new lows. That has turned the 5-period moving average up. 10-day, we are continuing to advance. Accumulation distribution. We're also seeing some improvement here. We were able to get back above the moving average. However, the moving average is declining, but we are above it. The only way we can get that moving average to turn back up is if the blue line stays above the red line. Short-term charts. McClellan Oscillator has gone positive and not necessarily extreme. Force Index getting right back up. It's still negative, but it's showing a lot of recent improvement. Stoke Rsi above 0.5 and rising and not extreme, at least yet. Williams percent R slightly negative still, but showing a lot of improvement. 20-period moving average study coming up after an extreme negative reading, as is the 50. 200 is starting to move higher. Stochastics coming out of this extreme negative reading that it seemed like it couldn't get out of. So short term is looking better, intermediate term is looking better, We're trying to turn up with the long-term stochastics. And this is just to show that maybe we kind of overdid it. A 2% move is pretty big for one day. So looking at the advanced decline ratio, we're pegged up here at the top line. It doesn't mean that we can't go higher. It doesn't mean that we're going to have a negative day. It just shows that maybe we kind of overdid it and the market will need to readjust slightly. Intermediate term, rate of change, also looking extreme. Again, a 2% move. Now, we could go higher than this, but we just want to be aware. And then also remember that every day this chart will recalculate. So what is giving us an extreme reading may not look extreme tomorrow, even if we have an up day. It just means that we moved up pretty quick. The rate of change going back 20 periods, it's still extreme negative. Standard deviation is starting to come back down as we get closer to the mean price. The momentum oscillators are really showing some improvement. The slope has finally turned up. That's positive. The MACD is almost ready to cross. The KSD and tricks are still negative and kind of moving slightly. Where the PMO and the TSI, they are starting to turn up. Vortex, seeing a decrease in selling, increase in buying, but we're still negative overall. The Sean trend meter trying to come out of an extreme negative reading. The STO, positive based on price because we crossed above 0, just barely positive based on volume. We're at 8. So we just barely went into positive territory. The BPI, after giving an extreme negative reading, is continuing to bounce. The PMO is trying to turn up, as well as based on price and volume. The rising PMOs are really showing some strength right now. Might even be getting a little too fast, but this is a faster indicator. The PMOs percent that have a buy signal, that's coming up after being extreme negative. Those that are above 0 is flattening and just barely trying to turn up. The summation index based on price is finally turned up because the McClellan oscillator was positive, but we started to see this a few days ago based on volume. This sometimes can be a leading indicator, but it also can fake us out. This started to turn up at the beginning of May. It looked like some things might happen, but they ended up not happening that were positive. So we want to be careful. The boom indicator is showing some improvement. It's coming off of an extreme negative reading when looking at the 50-period moving average. We're bouncing slightly when compared to the 200-period moving average. Chaikin oscillator, it is slightly positive. It's going above this dashed line, which is the midpoint. Ease of movement, also showing improvement. TTM squeeze, showing some improvement as this that's now acting more like an oscillator is starting to go up. We've regained that anchored moving average and we're back above that. Looking at this longer term, it does look like we're extreme and we could be bouncing based on the TTM squeeze. Balance of power, slightly positive, just crossed above the dash line. Connor's RSI also showing some improvement. Our different charts looking better with the Heiken Ashi. Still negative with the Kagi chart. We haven't seen enough of a price move yet. Nor have we with the Renko. The 3-line break not redrawing yet with open candles, so that's still negative. The point and figure chart did draw in 3 green X's. And the double bottom breakdance, whatever signal that was that we saw, it's now off of here. So that signal is no longer valid. Different trading systems. We are back to positive with the S&P based on the Elders Impulse system. And with the SPY, we're positive. The SAR system continues to be negative with the dots on top. We're back in more of a pale purple area, so that would be more neutral with the go, no-go system. Long term, we're still below the moving average. Our longer term moving average study, we're showing some real improvement on the 50, 150, and 200 after getting pretty extreme negative. The special K, however, continues to go lower. Looking at the broad market, the diamonds are back to positive. The Qs remain neutral. They've got a little more work to do before they turn green. The Vixen also dropped on the bar and on a closing basis. So we're seeing a lot of fear coming out of the market, but there's still a lot of fear in other ways in the market. Looking at our broad range of the 5-period moving average of highs to lows, after getting a real extreme negative reading, we're coming back up into, it's still negative overall, but it is showing some improvement right now. Other areas, the dollar just got hammered. It was down 0.76. So now the euro is slightly higher than the dollar right now. And this is one thing to be aware of. A lot of people are going, why is the dollar doing so well? It's a fiat currency. It's not backed by anything. They might be replacing it with some kind of cryptocurrency or digital dollars in the future. Eventually, the dollar is going to go away. We want to keep an eye on that. Yes, the dollar has been doing well, but that's also because the euro and the Japanese yen have even been worse. So it's kind of like pick the least crappy currency out there, and right now the dollar is kind of in the lead. But here on this chart, put out by ICE Futures, says the dollar has overshot the relative performance of U.S. equities. It's really spiked up, where stocks have just kind of boom, bumper card down here. So it's just showing that the dollar's way out of line in relation to stock prices. The dollar not yet melting up into new territory. Can we break out? Because when we've hit this level above 100 before, the Chinese yuan was devalued back in 2015. It had been pegged to the dollar, and so if the dollar would go up, the Chinese yuan would go up. Well, it kind of topped out right here, and that really caused some problems for the dollar after that. Then we had Brexit happen that caught especially people in the US and in Britain off guard in 2015. And then in 2016, we had the election, which was a surprise. The dollar really spiked up then and then came back down. Then we had COVID. It went all over the place crazy. Dollar had trouble after that. Well, are we spiking now? And will there be some trouble for the dollar after we get done spiking? That's just what we're looking at here. Oil still is high, but it declined down to 112.40. Gold futures, they did advance slightly, but they're still below the 200-day moving average. And here's the ETF. The ETF actually declined and is below the moving average, and we're seeing a real rollover right now. Here's a longer-term look at the gold ETF. Silver was down slightly and is way below the moving averages, and we might be seeing a near-term death cross at some point. And here's a longer-term look at the silver ETF chart. Bitcoin for right now, it's just kind of hanging out around 30. Gets a little bit above, a little bit below, a little bit above, a little bit below. I think when I started recording, it was a little bit above, but it spent a lot of the trading session on Tuesday being below 30. So you get a lot of people that really don't know what's going to happen right now. They say they do. And man, you go into some of those chat rooms and you meet all these geniuses, but anybody can say anything. Bonds showed a little bit of a decline using our world bond index, and they're just showing a lot of weakness right now based on price. With the 30-year yield, we're still dancing around the 50% retracement from the all-time high set back in 2007 down to the all-time low set in 2020, and we've been able to retrace about half of that. Longer-term yields really advanced, where the shorter-term yield, the 3-month, it declined. The Japanese bonds are just kind of going sideways these days. Japanese yen is declining, but advanced against the dollar. The euro advanced against the dollar, but the dollar's still in a pretty strong uptrend. Can it break out some of these other levels that we've seen in the past? The euro's at 105.5, where the dollar's at 103.41. Are possible positive scenarios. These could be starting to set up. We have the Kopit curve. It has now crossed over. This is a pretty decent indicator when it comes to picking market bottoms, but it can give some false signals. We saw one back in February where it crossed over and we just kind of went up a little bit and then back down. But then we saw another one in March, and that led to the really nice run-up from the middle of March into the latter part of March. Is something going to happen? We could say that the Coppet curve is a little deeper than it was before, but it was deep back in late January, early February. That didn't really help us out all that much. So we just want to keep an eye on this and then use other indicators to see, are things improving? Here's a longer term look at the Coppet curve. This is about as extreme as we've been since the COVID plunge. The 2-year Treasury yield, it was up slightly on Tuesday, so we can't really tell if this is spiking up yet or not. The mass index, still waiting to see if it'll come down to 26.5. Has not done that. Praying bottom fisher, trying to turn up, but has not crossed yet. The staples, they really fell because they underperformed. Are we seeing a viable signal here? We want to keep an eye on this. Sometimes when this spikes up, this marks a significant low in the market. But we've been fooled a few times over the last few weeks thinking this might be telling us something, only to come back and realize no. So, if you're looking to go long, one of the areas that you'll probably want to keep an eye on for Wednesday are the staples, and specifically the staples to the S&P 500 ratio. Are the staples outperforming the S&P 500? If they continue to underperform, that means that this will drop and we may have a better chance at this actually spiking and potentially giving us some kind of a valid signal. Kind of dangerous to just take this on right now because things could change. We're not really seeing anything with the small cap to S&P 500 ratio. It was up. We want to see the red chart really pop up. And it did a little bit, so we'll keep an eye on this. If this starts to advance, then maybe a few days after that, the blue line, which is the S&P, it might be able to advance as well. So what's our outlook for Wednesday? The technicals are improving, but needs follow through. The markets have broken below the trendless intermediate term range, but we regained that long-term support. That could be positive. Growth won on Tuesday. Value won on Monday. Growth won last Friday. What's going to win on Wednesday? Economic reports. We have housing starts and building permits coming out on Wednesday. And then every week we get the mortgage applications index. Geopolitical events. Russia, Ukraine. Yeah, Finland's going to go ahead and be part of NATO from what I understand. And Russia doesn't like that. But so far it hasn't really led to any kind of significant escalation. China may be slowing down with their lockdowns, which could help the supply chain. We're still dealing with inflation and interest rates. We want to keep an eye on oil and the different stories that go around that. What's happening in China, what's happening in the Middle East. Earnings that are coming out, any Fed speak that may or may not happen, and then the longer term scenario that we're looking at for Japan, to look at their interest rates, to see their bonds, and then try to figure out, are they going to get to the point where they need to sell U.S. bonds? So our scenarios, we're still down overall. But I have a question mark here because we're not seeing this really strong relationship between interest rates and stocks right now. Earnings, Fed speak, all that stuff could drive things lower. Technicals are negative but improving, but we had a couple of indicators showing that maybe we went up too far, too fast for one day. So it might cool off a little bit. Positive scenario, we see improving technicals and we're still extreme negative with sentiment. Both of these are potentially positive. The possible positive scenarios that I went through, there's really none of them that have really clicked yet, but we're keeping an eye on those. And the technicals. Pivots, previous levels may provide either support or resistance. Sideways, we're above 20 and we're showing a negative trend, even though if we see more upside from here, the ADX is likely to weaken. So our conclusion is the S&P is negative overall. It's negative but improving in the short term as well as the intermediate term, and long term it's still negative. So have a great day and I'll prepare the next video after Wednesday's session.